Welcome to TradeTheMBI.com. This is John. This report is for the 5th of September, post-Labor Day event. And of course, we opened up after the weekend with a slight decline. The whole threat of, nuclear holocaust in North Korea. But it's a little over dramatic because at the end of the day, you are still going to wake up the next morning, and if the entire world hasn't been destroyed, then what are you going to do with your money? And that really becomes the question. So you could have a risk-off trade, but at some point you have to still be somewhere with your resources. And so I wouldn't call that brief dip much of anything. It was interesting because even within this, I was looking at our daily MBI Opus one. We just had that Predator Hawk from down over here that moved up. We can go ahead and look at the report. We're still been battling the equity curve. Been back and forth this whole year, going slightly to the higher. We're almost back to the peaks. It just had a couple of awkward trades, of which we pointed out. Periodic returns for the years to date. It's been kind of muddled, and this is part of that influence of the Fed. That's the MBI Opus, but you can also do the Power Mode 2, Opus 2. We look at that when you can go to Format Strategies, and then they pop up, and this is the Power Mode Opus 2 version, which is very nice because what it does is it runs with trends. For instance, it's in this one right now. Strategy report up, and we'll take a look at that one later. So we'll go to the general. The reason I don't show this very much is because of this right here. 51%. So it's basically flipping a coin, but when you flip that coin, you're going to get twice as much money for your wins compared to your losses. And that's resulted in a net trade there, 2 million in losses, but $1 million in gains. So horrible win rate, but it produces a fairly stable graph. If you follow those lows going across, we're in the slight down peak. It should finish somewhere right about there. Of course, with this trade that it's in right now, there's going to be a win, so that may actually just abbreviate it and go back up towards the highs. The thing is that any single trade can move you to a new high, even if you're on a dip from the equity highs. And so, they have the wonderful saying, buy the dip. Well, in this particular case, you bought any dip in this equity curve. It's resulted in good money. And that's just from a periodic return. 2015 was a rough one. And what it was is at the end of the year, there was a trade that really did well, but didn't close out until the following year, which is why 2016 had such a big number, because it would have negated this loss and given it a modest one. But neither here nor there. I mean, that's just picking the time frames. But you can see on decent years, a couple 100,000 is not out of the question. This, again, is the same 10 contracts for each entry going through. What you're starting to see here is, this happens to be the readings of the Omega converted. Right there you can see the 1079 is the orange, and the secondary number is the red DOC. And what that's indicating is that after a dip, and then what you see here are these numbers. So we have a 5, a 6. Get that one out of the way because that's a stop value for the program that's currently running. So that's where the current stop is at 24.49 from where it is at 69. So it already tells you where you're at stop-wise based off your entry. So it's already locked in 9 points on that one. But the 5 is the orange dipping below green. The 6 is the orange dipping below the red. And the 7 represents that the shakeout's yellow is above the magenta. And so what it's developing is increased pattern for, I would say, strong success entry points. And they're further going to be defined. And then what this will do is it will create the new paint bar that will establish buys, as well as in this particular case, this is run off the ABM DOH. And once it's converted, what you'll get is a reset of the ABM yellow at these key points that meet all of them. There's still a bunch more criteria, but I have to examine each one of them as we go. And in some cases, it's not always productive to eliminate every single one of them. So there may be a rating, and that's why I'm giving these numeric values, because I find that if I eliminate all of the ones that don't meet every criteria, you might miss a couple of very decent runs. But using the Fibonacci retrace level here, along with the long-short algos, we'll be able to make up for some of that. In this particular case, because, well, I'd have to shrink this chart quite a bit, I think, to find some of the low peak runs, because we've been in a nice, pretty long, sustained. I mean, and this is another thing to look at. When you follow this fib retrace, notice we've stayed above that 50% line throughout this time. This goes back all the way into the beginning of the year. So that's pretty impressive from a standpoint. We haven't had any significant movement other than the dips that we had right here, and that's only because we've had a compression of the range, and that's what's led to the tightening. So this is the lowest we've been for the better part of 6 months, and have recovered all the way back through it. So always need to look at it from that standpoint, but always good to look at the strategy aspects as well, and how that's going to be also applied to look at this one, the 50K chart, for all the examinations that it's doing. It concluded its trade, well, right here at the early part. 88, so where was that entry? 37, and the first one was at 35. I'll take a look at that. Let's see where it's at for the year to date. So for this year, just under. This one, though, has a bit more dramatic swings from equity curve standpoint. Gyrates quite a bit more, and we're going to be changing it to the point where it won't have that dramatic swing nature, because, like in this situation, once we get above the key fib levels, then it will trigger the stop before you end up with this kind of a fade situation that goes down too early. So that will improve it dramatically, because to me the drawdown aspect is a significant one. It's one thing to have 50-50 trades as long as you're not losing significant capital during those things. Now, of course, like going back to this one here, where the results of it give you a broader perspective of how you can mitigate that by obviously taking advantage. And see, this is one of those criteria that I always look at. Larger trades in a downturn on the equity curve, for me, always produce outside gains, which is counter to a lot of people's thinking, because they're like, well, if you're in a losing streak, the last thing you want to do is add to it. Yes, but we can compare exactly the number of consecutive losers that we're likely to have, and that really provides a consistency, because you can go through and it'll tell you the number of consecutive wins, the maximum number of losing trades. So in this particular case, 8. So if you get into a losing streak of 4 or more, you know you're not going to have more than 4 trades more before it flips, and that's at the highest peak. And we can go through and find out exactly where that is based on all of these performance graphs and everything. So that becomes effective. And what I'm hoping to do is also mitigate the loss factor based on the use of the Fibonacci. And also because we know that when we see this rise of the low, we expect a return down to at least 50% or to the bottom. And in some cases, then that will cause us not to want to exit a trade just on an arbitrary amount, but rather a level. So little things like that. But I'm getting long in the wind on that. So from the daily standpoint, we're looking good. From basic standpoint so far, we don't have any great signals. The euro holding up strong has really been positive for keeping the market alive. The fact that the economy is growing significant, yeah, that should put significant pressure. I know a lot of people have been seeking that as a safe trade to get away from turmoil, but there's no yield there. It's this ridiculous trade to be in treasuries, but some people are willing to lose money to be safe. which it's an interesting one. Oil, slow rebound, but again, I think that the reduction in supply is going to have well, I wouldn't say supply, but the reduction in the ability of refining capability in the Gulf certainly is going to have a little bit of impact on things. But what we're seeing is economic growth, which is going to impact supply as far as the need for more of it, and that is going to be a bolster to oil in general. But it gives us a clue that the economy is moving in the right direction despite all of the fear talk. You can't be growing at 3% and think that the market is going to be falling. That's kind of a strange dichotomy there, and gold, of course, has to go this way. This is a clear indication that you're having that kind of improvement, because built into that will be some type of wage pressure, and particularly if you're having the potential DACA thing ending, which, I mean, I know they talk about 1 million jobs being lost. I think that's a bit specious, but the reality is those are just going to get transferred. The jobs aren't going to stop existing. They're just going to move to Americans, which will further improve the labor participation rate for actual Americans. And so that, despite what you think about, whether it should or shouldn't, it's not relevant to the economic impact, and it's not going to have any. So, but limiting the immigration and the number of people that come in certainly will have an effect on wages to the upside, which is inflationary, and that's usually the biggest problem, because the goal for the entire last 8 years in the Fed's plan of you need to have lower wage increases will always keep inflation in check, and changing that policy has completely reverted it. So if we look at the 5K here, we can see that we ended up with a couple of early short signals that never really went away after this DOC spread right over here, and we just continued to fade slowly. And then, so it was even in the complete sell breakdown, and then sure, we opened up lower off of the North Korea thing, but we've regained, right at the 50% mark, and it would make sense that you would hit that resistance right there. So could come back a little bit from there before moving further to the upside. So there's going to be a little bit of challenge for the market here at the start of the week, particularly with some of the uncertainties. They're just looking for things to cool off, and of course you got the other hurricane, Irma, coming. So there's a lot of systemic things that are going on, but within that, government shutdown and budget are going to be the priorities, because if Congress is forced to act, raises the debt ceiling and those kinds of things off of the heels of their Harvey and then the potential next hurricane, that could bolster this market and bring it to new highs. So we will keep an eye on that. Sorry for going for too long here. As always though, trade well.